Well, today we're going to focus on currencies, and to take us through his favourite pairs, Clifford Bennett, Chief Economist at ACY Securities, joins us now live. Clifford, great to have you on. Look, lots going on in the FX world at the moment, but the Australian dollar, though, it seems very much range bound. What are your thoughts? What's going to push it out of this range?
Great to see you. Well, probably an Australian recession might do the trick. Now, we really have been in a very established range, sort of 73.30, 74.25 for quite a while. We kind of picked that range pretty early, but I didn't think it would last quite this long, but we're still there. I mean, if the Aussie were to break up through 74.25, 75.25, maybe it does get that get out of jail card that I said it doesn't have more recently. So, but really above 74.25, early warning, 75.25 hope, but the far more likely scenario is, and my forecast now, as of today actually, is that Australia is going to experience a recession in Q3, Q4, and the Aussie is probably headed to 70 cents. I mean, the worst case scenario would be 65, but somewhere in that 72, 68 cent area, there should be good long-term buying from our exporters, but certainly 70 cents, as I first said at nearly 77.5 cents, is a reasonable target this downtrend that the Australian dollar just had to have.
And so, Clifford, how long then, in your mind, does this recession last? How long is that time frame for the Australian dollar to push towards that 70 cent mark?
Well, I think, we could easily be seeing the Australian dollar around 70 cents by Christmas. It's not that far. I mean, we moved through the 77 to where we are now, 73.5 area pretty quickly. And I think the same sort of price action could develop. The recession here for Australia could be prolonged because it's the government's response is a more targeted one, which is appropriate, but targeted support for businesses and individuals suffering, not broad sweeping. And also, Australia's lounge rooms are chock-a-block full of sofas and new TVs. People just can't buy any new ones the way they did coming out of the last COVID downturn. So I think what we're going to see is not a quick recovery or bounce out of this experience, but a more prolonged, gentle recovery, a strong recovery, but don't expect that boom environment that we had in more recent times. And I think, you have to remember as well that the RBA has no ammunition left. And anything it would do anyway, such as increasing its bond buying program, might help the stock market for a moment, but it's not really going to change the economy. And the Australian dollar would fall through the floor on that sort of development. So there's nothing left really to support the Australian dollar. Everyone was euphoric about an ongoing economic nirvana that simply couldn't last. And now with the Delta strain, the sun is setting and on the Australian economy. And unfortunately, the road is only leading towards further lockdowns, it would seem, as the ACT has gone into lockdown today.
Well, Clifford, what are traders doing? What is the sentiment like on the ACY platform? Do the retail guys think that the Australian dollar is headed to that downside?
Well, that's really interesting, actually, because the ACY sentiment indicator is showing that of our clients, 50.9, ticking up this afternoon, interestingly, sort of 50.22% of people are short the Australian dollar at the moment, and that is not a big number, which means there is plenty of fresh selling power in the market should it begin to topple to the downside again. I think a lot of people have got frustrated with this consolidation period and bought back any shorts they had. Some of the miners are probably coming in and doing some hedging, but I don't think they're going to be doing a lot. And certainly if the Aussie continues to weaken on a worsening Delta situation for New South Wales, Victoria, ACT, hopefully not, but it does seem almost probable at the moment. And in that environment, I think you will see renewed selling. And when we start breaking through those support levels, there'll be plenty of fresh selling power to the downside.
Clifford, is this the trade for you, though, in this market? If you're going to trade the Australian dollar, is it against the US dollar, or are you looking at some of the cross rates?
I think you'd have to do both. Good question, Cara. I think you'd have to do both, just in case I'm wrong about my US dollar strength, because on top of this, all of this weakness, bearish Australian dollar, information. There's also a very strong US dollar environment at the moment. But if I'm wrong on the strong US dollar aspect of my Aussie call, another interesting trade to have would be sterling Aussie. We've been bullish sterling Aussie for quite some time. And this market has the potential to go up sort of 194.5, 195. It's already come a long way, but it's doing some nice consolidation there. And as you can see on the chart, it's a little bit similar in nature to the last major period of hesitation before we had that big upswing. So I think 1.95 for sterling Aussie is a potential target, and that would happen pretty quickly if the situation with Delta in Australia continues to deteriorate, which is exactly what it has been doing. I mean, that has been the trend, unfortunately. And if that trend continues, we're going to see more lockdowns for longer than any of us would like. Recession is a certainty, I would think now. So that's our forecast, our central forecast. And that sterling Aussie scenario could move to the upside. Sterling Great Britain coming out of the worst of its experiences and starting to manage the crisis in a nuanced way, there is a good argument there for sterling Aussie rising on the cross.
Yeah, do you see sterling as an outperformer against a multiple basket of currencies, given their backdrop of that vaccine rollout and the recovery that we're seeing there?
Yeah, I mean, there's many aspects to that question, Cara. I don't think the vaccines are going to be quite as effective as people hoped, but they are going to be effective to a significant degree. I think the UK is one of the most experienced economies in the world now at handling a Delta outbreak, and it has those high vaccination levels. And I think a more nuanced response will see the UK economy managing a crisis better. It doesn't mean everything will be great in the UK. It's just that they will have better management and a more open economy in the foreseeable future than some other parts of the world, particularly Australia and New Zealand are in different unique situations because we haven't had that really serious first wave. And so we're trying to hold the virus down. And that gives us a different policy perspective, which again should support that Aussie sterling cross or sterling Aussie cross.
And Clifford, let's round it off by having a look at the euro trade. Let's have a look at the chart. What levels are we looking at here? It's a very popular one, isn't it, amongst those retail traders?
Yes, I think it is. And I think the market's going to try and have a bit of a bounce here. I mean, the US dollar has been strong for quite a while. But again, I would suggest to people, there's a lot of risk to the downside here, particularly while we stay under that 118.15, even 117.70 resistance levels on the euro. And I think, the big picture risk, it's important to highlight big picture risk because sometimes it's what actually eventuates. But the downside dominant risk for euro, I would think, is towards 111, 112. And that's based on really the rest of the world being a little bit panicked about Delta and wanting to buy the US dollar as a safe haven and wanting to buy US stocks as a safe haven. So all of that pressure is pushing the US dollar to the upside. And the euro is, it's always the tortoise, not the hare in the recovery stakes. And we're going to see interest rate hikes in the US far before we see them for the ECB. And so, yes, I think euro 111, 112 is a real possibility.
Clifford, this is a bit of a funny question, but I always like asking it. What's the currency pair that you always avoid trading based on maybe volatility or certain levels that you don't like? I know a lot of traders don't like looking at sterling on their screens. I've had a conversation with many traders about that one, but what's the one that you like to avoid?
I must admit, at the moment, I'm avoiding the dollar-yen cross. It's a difficult one for me at the moment. But I think it's important for people when they're trading currency markets not to try to get the whole matrix correct. So if you're trading euro-yen, dollar-euro, euro-dollar, dollar-yen, don't try to get all three to match up. Just trade each one individually because they are individual animals and need to be handled that way. And I also think markets go through periods of patterns of behavior of up to 12 to 18 months. And so you might be a good trader in a certain kind of market environment, but it won't last forever in that particular market. But you might find that pattern of behavior in another linked market. And you have to be able to sort of shift your focus a little bit. But at the moment, I'm not really trading the dollar yen.
Well, there you go, Clifford. We'll avoid talking about that one for the weeks to come. Always great to check in with you. Thanks so much for joining us this afternoon from ACY.
Cheers.